Systematic risk and beta introduces the concepts of market risk and beta as fundamental components of portfolio theory within the program. Systematic risk refers to the portion of total investment risk that affects the entire market or broad segments of the economy. Unlike company-specific risk, systematic risk cannot be eliminated through diversification because it arises from macroeconomic forces such as inflation, interest rate changes, recessions, geopolitical events, and changes in economic growth expectations. Since all securities are exposed to these broad influences to some degree, investors must accept systematic risk as an unavoidable component of investing. Understanding systematic risk is essential because it directly influences expected returns, portfolio construction, and asset pricing models. The topic distinguishes systematic risk from unsystematic risk. Unsystematic risk, also called specific or diversifiable risk, arises from factors unique to an individual company or industry, such as management decisions, operational problems, product failures, or competitive pressures. Diversification across multiple securities can substantially reduce unsystematic risk because company-specific events tend to offset one another within a portfolio. Systematic risk, however, remains even in highly diversified portfolios because broad market conditions affect nearly all investments simultaneously. Consequently, modern portfolio theory concludes that investors are not compensated for bearing diversifiable risk, since it can be eliminated cost-effectively through diversification. Expected investment returns are therefore primarily linked to exposure to systematic market risk. A central concept in the topic is beta, which measures a security's sensitivity to movements in the overall market. Beta quantifies the relationship between the return of an individual asset and the return of the market portfolio. A beta of 1 indicates that a security tends to move in line with the market. A beta greater than 1 suggests that the security is more volatile than the market and amplifies market movements. Conversely, a beta below 1 indicates lower sensitivity to market fluctuations. Negative beta values are rare but imply that the asset tends to move opposite to the market. Beta therefore serves as a practical measure of systematic risk exposure. The topic also explains how beta is estimated statistically using historical return data. Beta is calculated as the covariance between a security's returns and market returns divided by the variance of market returns. In practice, regression analysis is commonly used to estimate beta values by comparing historical security performance against a broad market index. Securities with high beta values may offer higher expected returns because investors require compensation for assuming greater market-related risk. However, these investments also experience larger losses during market downturns. Low beta securities generally provide more stable returns and lower volatility, making them attractive to more risk-averse investors or defensive portfolio strategies. Systematic risk and beta have important implications for portfolio management and asset allocation. Portfolio beta represents the weighted average beta of all securities within the portfolio and measures the portfolio's overall sensitivity to market movements. Portfolio managers may adjust portfolio beta depending on market expectations and investor objectives. Aggressive portfolios often target higher beta exposure to maximize returns during favorable market conditions, while defensive portfolios may emphasize lower beta assets to reduce downside risk during economic uncertainty. Understanding beta also helps investors evaluate whether portfolio performance results from manager skill or simply exposure to broader market movements and systematic economic factors. Overall, topic demonstrates that systematic risk is a fundamental driver of expected investment returns and cannot be diversified away within financial markets. Beta provides a standardized measure of how strongly an asset or portfolio responds to market fluctuations and serves as a key input in portfolio management and asset pricing analysis. By distinguishing systematic risk from diversifiable risk, investors gain a clearer understanding of how diversification improves portfolio efficiency while still leaving exposure to broader economic conditions. For CFA candidates, mastering systematic risk and beta concepts is essential because these principles form the theoretical foundation for the capital asset pricing model, security valuation, portfolio optimization, and professional risk management practices.